Welcome to my presentation on how to value a business using return on invested capital and free cash flows. Any business is going to derive its value from these four drivers. You have the return on invested capital, the growth rate, how much the business reinvests back into itself, and the weighted average cost of capital, which is your discount rate. These four drivers determine the value of any business. So let's see how this all fits together and how this works. Let's create a fake business. Let's say we go to a bunch of investors and we borrow a bunch of money and issue some shares of stock. So let's say we raise $1,000, okay? And let's suppose that we can earn a 20% return on this $1,000 in the first year of running the business. So I can generate operating profits after taxes of the invested capital times 20%. I now have net operating profits after taxes using this little formula right here, which represents the profits generated from the company's core business operations. Okay, of this $200 that we just earned, we're going to put some of this back into the firm and to help it grow. So let's say we're going to put back 90% of this $200 back into the business. How much are we adding back into the firm? Well, that's called net investment, and that represents the increase in the invested capital from one year to the next. So the invested capital in the following year will increase by 180. Continuing along, as the firm gets older and competition catches up with us, the return on invested capital naturally will slowly decay. So let's say it goes down from 20 to 19.5. So we lost 0.5%. Well, the invested capital in the previous period was 1,180 times the return on invested capital gives us the net operating profits after tax at the end of year 2. And let's suppose that, as we're getting older and we're no longer a startup company, it becomes harder and harder and harder to find investment opportunities that are profitable and worthwhile doing. So let's say that this is 85%. 85% of this $230 will be added back into the firm to help it grow. This represents the net investment, which again is the change in the invested capital from one period to the next. So the invested capital is going to increase by 196. All right, so we have now created the first 2 years of running our hypothetical business here. And let's say that the return on invested capital again drops. Okay, continuing along, we can just copy these formulas over and we can see that here, let me just change this back to, that's not right. Let's put a reasonable number here. Let's say our investment rate drops to 75%, okay? So our return on invested capital is now 18.9. Operating income after taxes is 260. 75% of that goes back into the business. That leaves us with a net investment of 195, and then we add the 195 to the previous year's invested capital, and we are slowly growing our business. Okay, continuing along here, let's say that the return on invested capital going forward drops to 18.4. The net operating profits after tax would be, of course, the prior year's invested capital, just like it says right here. The prior year's invested capital times the return on invested capital gives us the net operating profits after tax. And let's suppose that, for simplicity, that this is 75%. So we continue to invest 75% of our operating income back into the business, which means that our invested capital will increase to 1,787 by the end of year 4. Okay, and we're going to forecast up to year 5. Okay, and you will see that I'm going to show you how to do a horizon value or a continuing value shortly, which will take care of all of the future values that you see here beyond year 5. So what we're basically doing is we're going to forecast 5 years and then figure out the value of the business right away. But I'm going to show you how this all fits together. Okay, so let's say, just to finish off here, that this is 17.8. So the prior year's invested capital times 17.8 is the net operating profits. And let's say that we are now going to be investing 70% back into the firm. So our invested capital rose to 2010 by the end of year 5. Okay, so let's say, and you can see what's happening here. The operating profit is shrinking over time, and here's how I'm calculating that. I'm taking the newer value over the older value minus 1, or you could do ending minus beginning over beginning, and that gives you the percent change in the net operating profits after tax between each consecutive year. And down here, we're calculating free cash flows. Now, free cash flows is the cash flows that the business generates after deducting investments in new capital, and you've paid your taxes and whatnot. And there's 3 ways to calculate free cash flows listed here in this little footnote. And so right now what I'm doing is I'm just taking the first formula right here, where you just take the net operating profits after taxes and you subtract your net investment, okay? So we earn some money, we put some money back into the company, whatever's left is called free cash flows. And those represent the cash flows available for distribution to all of the owners of the business. Okay, hence the word free cash flow. And the business would continue to operate as if nothing happened. So that's where it gets its name, free cash flow. It's not that they're free, it's that you've paid for the lights, the workers, the investment needs, the taxes, all this stuff. And you could, in theory, extract $20 in year 1 out of this business, and it would not affect the operations of the firm itself. So that's what free cash flows represents. Okay. Now, the value of any business is the present value of all future free cash flows until the end of time. Now, we've only modeled the first 5 years, so using the NPV function, let me show you how that works by showing you the formula inside of here. So what we're doing is we're taking the weighted average cost of capital, I'm assuming a WACC of 10%, and we discount these future free cash flows. Now, we've only done 5. And that gives us the value of the business. Now, this is assuming that after year 5, the business is liquidated, it's sold off, it will never make money ever again. That's probably not realistic. So what we're going to do is we're going to assume that the business will continue to grow after year 5 using some assumptions here. So let me reveal my assumptions, okay? We're going to assume that in year 6, 7, 8, 9, all years after our explicit forecast period is done, we're going to earn a return on new invested capital of 11%, and we're going to invest 50% of our operating income back into the business, and fundamentally, that gives us a growth rate into perpetuity of 5.5% by taking the product of these 2 numbers, okay? So what that means is our operating profits after tax are going to be growing by this growth rate right there, okay? Now, as you can see here, I'm calculating these percent changes, and now that's 5.5%, which matches the 5.5% for everything beyond the forecasted period. Now, what would be the return on invested capital? Well, here's another definition of return on invested capital. It's the net operating profits at time t, so that's the 336, divided by the invested capital in the previous period. So there's that, and that gives us the return on invested capital. And this is going to decrease over time and converge to 11%. I'm going to show you that in a minute. For the investment rate, we're going to pick the 50%. And for the net investment, we're going to take the 336 and take 50% of that, which is 168. Finally, our invested capital will increase by 168. And as soon as I press enter, all these other values, I've done the exact same thing, going from year 7 on and on and on for like 1,000 years, which I'm not showing here because it can't fit on the screen, but these numbers will automatically populate. Watch. Bam. All of the values populate, and now the value of the firm is the present value of all future free cash flows until the end of time, into perpetuity. It just never ends. Discounted at the weighted average cost of capital, and that is the value of our business, 2,519.77. Okay, but here's the trick. Nobody really wants to estimate all of these future free cash flows, forever, because it's not practical to do, and so on. So what we're going to do, essentially, is we are going to do something called a horizon value, which what this formula does, and this is from the McKinsey Valuation textbook, what it does is it captures the present value of all future free cash flows after year 5 until the end of time. So here's how you would calculate that. using this formula that you see right here. You take the net operating profits after taxes the following year, okay, times 1 minus the horizon growth rate. So we're going to be growing at 5.5%. Our operating income is going to be growing at 5.5% forever until the end of time. And we divide that by ROIC, the return on new invested capital, which is what the return on invested capital will converge to over time. And we divide that by WACC minus G, which is the 10% minus the 5.5%, and that gives us the continuing value, also called the horizon value. Another name for this big number right here is the terminal value, and they all mean the same thing. Okay, so here is the grand finale. We take the present value of the first 5 years free cash flows using the net present value function, discounted at the weighted average cost of capital, and that's the first piece of the puzzle. Then we discount back this horizon value 5 years back to time 0, and I'm using the present value function that's built into Excel. So we got the rate is the WACC, the number of periods is the 5th year because that's where the horizon value appears. There is no payment here because we're just discounting a lump sum back to the present. Press enter, and that gives us the present value of the horizon. Now we can add these two figures together, and voila, you will notice that the value of the business matches our answer that we calculated earlier. Okay, so that is the fundamentals of how these things allow you to value any firm. Now, any firm is the present value of all future free cash flows, but the interesting thing is that ROIC, the return on invested capital, the growth rate, and the investment rate are mathematically related to each other, okay, in this fashion. So here are the formulas that I came up with. If you are explicitly modeling the return on invested capital and your growth rate in your operating income, you need to match the investment rate to that using the first formula right here, which is method, I'm calling this method A. If you are modeling the growth in your net operating profits after tax and the investment rate, you need to make sure that your return on invested capital matches in each period, and that looks like this. Or if you're explicitly modeling the return on invested capital and the investment rate in your explicit forecast period, you need to figure out what the growth rate is in your operating income using this formula, okay? Because these three drivers are connected mathematically, okay? For example, all right, let's say that I was trying to show you, let's see here, which one should we choose first? Let's say we want to show you that this formula right here, let me just remove this. Let's say we want to prove that this relationship holds, okay? So if you have the growth rate, the return on invested capital, you can figure out what the investment rate needs to be to make that thing work, okay? Now, we use logic to figure out this timeline right here, but how else would have you been able to get this investment rate right here, okay? So let me show you how that would work, okay? I'm just going to put that into a row down here. The investment rate at time t, okay, so I'm using this formula right here. The investment rate at time t, we know it's 90%, right? But here's how you would do it. You go 1 plus the growth rate at t plus 1, which we already figured out is 15.05%, right? Divided by the return on invested capital in the following year, so that's this guy right here, minus 1 over the return on invested capital at time t, and that gives us 90%. If you drag this all the way across, you will see that these numbers right here will match the investment rate that I have in the original table, okay? So if you have modeled the return on invested capital and the growth rate in your net operating profits, you could use this formula to figure out what is the investment rate that is necessary to keep your model consistent, okay? Now let's go to method B, which is showing if you're modeling the growth rate in your operating income over time and you're modeling the investment rate over time, how is the return on invested capital behaving? And that's this formula over here, which I'm going to copy into our little model. let me grab this little formula. All right, here we go. And let me move this out of the way. Okay, so let's say we wanted to calculate these numbers right here because we have estimated the investment rate and the growth rate in our operating income. So let's say these are the inputs that we already have, the growth rate and the investment rate. Well, your model must be consistent. So we could use this little formula right here to estimate what the return on investment capital must be to make the model work. And it goes something like this, okay? So the return on invested capital at time t equals the return on invested capital from the previous period, so that's the 20%, times 1 plus the growth rate over the return on invested capital from the previous period times the investment rate from the previous period plus 1. And that should, if this all worked out, give us 19.5%. And it did. And if you drag this all the way across, these numbers right here should match these figures up here. And it does. So for internal consistency, if you choose to model your timeline in a different way, you could use this formula right here to estimate what the return on invested capital must be to keep the growth rate and the investment rate consistent with your model. Okay, so that takes care of method B. Now method C is basically, you're explicitly modeling the return on invested capital and the investment rate. Well then, the third variable that has to work with these guys is the growth rate. And for that one, we're going to be using this particular formula on the very bottom of the screen there. And let me copy that into our little sheet here. And I'm just going to show you, I'm going to do an informal proof of my formula that I derived. And it looks something like this. So let's say we wanted to model and figure out another way of estimating the growth rate in your operating income. Well, you could do that with this formula right here. So suppose you know what your return on invested capital is because you've modeled that explicitly. Let's say that's 19.5%. And you also know what your investment rate is over time. So those two inputs allow you to estimate what the growth rate is in your net operating profits. So to use the formula, we need the return on invested capital at time t. So that's the 19.5 times the investment rate from the previous period plus 1 over the return on invested capital from the previous period minus 1. And that's the 15.5%. So if you drag this all the way across, it should match the growth rate figures that we have calculated in our original model. Okay, so that is how you keep everything internally consistent in your model. If you have two of these three variables, okay, the ROIC, the growth rate, and the investment rate, if you have two of those three things, you have to make sure that the third thing is internally consistent with the other two. Okay, so use these formulas right here that I'm providing for you. I've done a lot of algebraic manipulations to come up with these, and I just proved to you, using our little model, that this does indeed work. Okay, so another thing I wanted to mention here is, well, we said that the return on invested capital in the long term, right, going into perpetuity was 11%, and I said that that implies that our ROIC is going to decay to this. In fact, let me show you what I mean by that. I made a chart over here to explain this. Okay, so I am graphing the return on invested capital over time, and over the next 20, 30, 40 years, you could see that it's converging to 11%. Meanwhile, the growth rate drops very quickly to our 5.5% targeted growth rate, and the ROIC decays slowly to the desired ROIC, which is 11%. Okay, and that's what this particular formula does if you make this assumption right here. Let me get rid of this so it's a little bit easier to see. If you make the assumption that your net operating profits after taxes grow by the growth rate that you have chosen at 5.5% forever, then when you apply the horizon value formula, the return on invested capital will slowly decay and converge to your targeted return on invested capital of 11%. And that makes sense because over time, competitive advantages go away. Okay, economic moats don't last forever. So we would naturally see a decay in the return on invested capital. Now the growth rate should drop quickly, and here is the reason why. Here are some charts from the McKinsey Valuation textbook. I own every edition of this book, including the 6th edition. I highly recommend you pick up this textbook. It is amazing. And here is a study of how the return on invested capital behaved over time in various portfolios of firms. So here are the high return on invested capital firms. Here are the firms that have a low return on invested capital, and you can see that there's mean reversion. And they all seem to kind of converge to around 10% over a long period of time. But ROIC tends to persist for a long time. Meanwhile, if you look at this chart over here, this is the growth rate in your revenues and your operating income, assuming your operating margins are the same each year. Okay, your revenues quickly drop to around 5% for all companies. And this is data based off of real firms being analyzed, and it very quickly drops. So when you're modeling a business, I recommend you create a pro forma financial statement for at least 5 years and have the growth rate, slowly decay. And then in year 5, you want to pick these two numbers such that the growth rate, the fundamental growth rate, which is the product of the return on invested capital and the return on new invested capital and the investment rate. If you multiply those two together, you get the fundamental growth rate, which you can see here is going to persist forever. Okay, and what I've chosen is a number close to around 5% because that is pretty darn accurate in the real world using real data. That's what happens. So that is what we choose. Now, as far as the investment rate goes, you can use the investment rate formula right here to figure that out over time, or you can reverse engineer this, which is going to be the growth rate divided by the ROIC. If you rearrange this, that gives you the fundamental reinvestment rate for your firm. Okay, so that is the story. That is how you value a business using the return on invested capital, the continuing value, and the hard part really is figuring out accurate measures of the net operating profits after tax, okay, because there's all sorts of accounting shenanigans that you have to undo and modify the financial statements to come up with your net operating profits after tax. You also need to figure out an accurate measure of your invested capital, which again is going to involve some accounting, some reverse engineering of the financial statements in the annual report. And then using those two values, the net operating profits after tax, you are going to estimate or look at how has the return on invested capital behaved historically. That allows you to make a projection for the next 5 years or so. And then you can choose a return on new invested capital, which is just a smidge. If you believe the firm is pretty good in the sense that it has some economic moats or competitive advantages, you can choose a return on new invested capital above the weighted average cost of capital. So that's what I've done here, where I'm converging it to 11%. Or if you want to be more conservative, you can change the return on new invested capital to your cost of capital, which is 10%. And that's going to give you, of course, a lower value for your firm, which is shown here in blue. So depending on your assumptions, once you've done your competitive analysis, you've done your Porter's 5 forces, the SWOT analysis, strengths, opportunities, weaknesses, and all of that stuff, you can get an idea of, hey, is this business likely to maintain a return on invested capital above their cost of capital or not? When in doubt, you could set this equal to the cost of capital. And that does not mean, though, that it will instantly drop to that 10%. Okay, as you can see here, it will slowly decay to that 10%, even though your growth rate quickly drops to your horizon growth rate magically. Okay, so this formula right here is absolutely amazing. And if you use this to figure out what your operating profits are in the next year, this one right here, the 334, and again, the way I found that is I took my horizon period, the last one in my explicit forecasting period, and I just bumped it up by the 5% growth rate. if you use this to estimate the net operating profits after tax 1 year after the end of your timeline, then your return on invested capital will decay basically exponentially to your target. Okay, that is not the only possibility for this behavior. What you could also do is just make the return on invested capital drop immediately to this 10%. So let me show you how that would work to finish off this video. Okay, so let's say, get rid of this. Let's say that our return on invested capital doesn't decay. In fact, it just instantly drops to that 10%. Okay, if that happens, then what would be our net operating profits after tax? Well, based off of this invested capital, we earn 10% on that. We get our net operating profits after tax. The investment rate, we're going to make that 50%. 50% of the 201 gets added to the invested capital, and then the rest of these will automatically populate because of magic. Actually, I just set up the spreadsheet that way, but don't worry about that. Now, what this does, let me set this back to 11%. What this does, if I just remove this growth rate for a second, is it drops your return on invested capital immediately at the end of year 5. It drops it immediately to 11%. But there's kind of an issue. By dropping your return on invested capital to 11% and keeping it there arbitrarily, you're violating what happens in the real world. So that's not a good assumption to make. Also, if you do this, then you're going to have a weird, dramatic drop in your operating income in the year after your horizon at the end of your timeline in year 6. Okay, so in year 6, our operating income drops significantly by 30%, and that's kind of weird that it would just grow, drop dramatically, and then start growing at 5.5%. That's just kind of weird. Why would that happen? So the more realistic assumption is to say, look, the growth rate will drop to our fundamental growth of 5.5%. The return on invested capital, we're going to recalculate as the net operating profits at time t divided by the invested capital in the previous period. And what that does is it creates this nice exponential decay in the return on invested capital, even though our growth rate drops pretty quickly after year 5 to our 5% growth rate or so. Okay, so really the main idea is that the higher the return on invested capital, the more valuable a business is. If the return on invested capital is bigger than the cost of capital, then a higher investment rate increases value. And how much you put back into the firm also impacts its growth rate. If you invest nothing back into your business, you can't grow. So again, let's just look at these consistency formulas right here. Make sure you look at these, because if you are doing some sort of an intrinsic valuation of any firm, these relations have to hold, as I've demonstrated in this video. As far as I know, these formulas are not in any textbook. What I've done is I've basically played with this model, and using algebra, I just derived them myself. So these are my little formulas, but feel free to use them to make sure that your model is internally consistent. ROIC, the growth rate, and the investment rate are linked together mathematically. Okay. Now, I will talk about how to accurately estimate NOPLAT, invested capital, and the weighted average cost of capital in another video. So for now, we'll leave it at that. And thank you very much for watching this video. And I hope you learned how to value a business using ROIC, NOPLAT, and the investment rate. Thank you very much.